Good day, ladies and gentlemen. I am Kyler Arian Caballero from grade 11 Copernicus, and I am here to present to you a video presentation about accounting concepts and principles for the subject Fundamentals of ABM. So today we are going to tackle 3 topics, but before we go to the main topic, which is the concept and principles of accounting, let us first know the definition and nature of accounting. Being an ABM student, of course we wanted to deepen our knowledge and skill in accounting. We begin our study of accounting with the most commonly accepted definition of accounting. According to Jerry J. Wagan, accounting is a process of identifying, recording, and communicating economic events, such as an organization, to interested users. So there are also 3 most commonly accepted definitions of accounting that are expressed by the following authoritative bodies. So first is the American Institute of the Certified Public Accountants, or the AICPA. According to them, accounting is the art of recording, classifying, and summarizing in a significant manner and in terms of money, transaction, and events, which are in part of at least financial character, and interpreting the results thereof. Second is the Accounting Standards Council, or the ASC. For them, accounting is a service activity. Its function is to provide quantitative information, primarily financial in nature, about economic entities that is intended to be useful in making economic decisions. Third one is the American Accounting Association, or the AAA. According to them, accounting is the process of identifying, measuring, and communicating economic information to permit informed judgments and decisions by users of the information. So as I have mentioned earlier, accounting is a process of identifying, recording, and communicating. So now let's find out what are these processes. Identifying, it means involves in the selection of the economic events which are important to a particular business transaction. Examples of transaction in the merchandising stores are sales of merchandise, purchases of merchandise, and purchases of delivery truck. Recording is the act of keeping a chronological record of events that are measurable in accounting documents like journals and ledgers. Communicating means it refers to the process of communicating financial reports to the users of financial information. First, we have discipline. Accounting is a discipline that observes professional standards and professional ethics as other fields of professions like medicine, law, engineering, and others. Ethics in accounting is of utmost importance. Certified public accountants, or the CPAs, and other accounting professionals know that people who use their services, especially decision makers, using financial statements, expect them to be highly competent, reliable, and objective. Those who work in the field of accounting must not only be well qualified, but must also possess a high degree of professional integrity. A professional's good reputation is one of the accountant's most important possessions. The service activity. Accounting profession is not involved in selling of goods. Instead, it is involved in providing professional services, particularly in performing tasks by making financial reports regarding the financial activities of economic entities. Next is art and science. As an art, accounting is designed to perform its service activity with utmost efficiency and in the best possible manner without any wastage of time and money. It encompasses a body of techniques that is commonly used in certain professions. It demands thorough knowledge, good experience, and deep interest in the field of accountancy to achieve this goal. Others believe that accounting it is not only an art but also a science as well, because it is regulated by accounting rules, principles, postulates, and theories. It follows a cause and effect relationship as shown by the double entry system, that in every transaction it has a double effect. If one account is debited, the other account will be credited automatically. On the other hand, some people dispute such an idea because accounting is not an exact science. In fact, accounting constantly adjusts to new conceptual frameworks to adapt in the rapidly changing business trends and situations globally. Next is we have the language of business. Accounting serves as a means of communication. It communicates the result of business operation to various parties such as owners, lenders, investors, government, employees, and other agencies who are directly or indirectly interested in the economic affairs of the business. It informs them the economic status of a business organization, gives them the insight regarding the true financial standing of the business as accountants interpret and communicate through financial reports. Next is the eye of business. Bookkeeping records as the initial part of accounting activities enable the owner of the business to check on his financial progress. Adequate accounting records assist the owner to prepare plans for the future, avoid material mistakes, analyze the causes of change that are take place, and draw the best choice among economic alternatives. Accountants are economic detectives. Auditing as an advanced part of the accounting activity verifies the truthfulness of the financial reports concerning the business operation and financial condition. So now let's go to our main topic for today, which is the accounting concepts and principles. So let's start with business entity principle. It is the idea that the business and the owner of the business are separate entities and should be accounted for separately. This concept applies to different businesses. Each business should account for its own transactions separately. Next is going concern principle. It states that companies need to be treated as if they are going to continue to exist. This means that we must assume that the company isn't going to be dissolved or declared bankruptcy unless we have evidence to the contrary. Thus, we should assume that there will be another accounting period in the future. Next is we have time period principle. It means that the financial statements are usually divided into specific time intervals. The business should report the financial statements appropriate to a specific period. Next is monetary unit principle. It assumes that all financial transactions are recorded in a stable currency. This is essential for the usefulness of a financial report. Companies that record their financial activities in currencies experiencing hyperinflation will distort to the true financial picture of the company. Next is we have historical cost principle. Requires companies to record the purchase of goods, services, or capital assets at the price they paid for them. Assets are then remain on the balance sheet at their historical without being adjusted for fluctuations in market value. Next is we have the matching principle. It states that all expenses must be matched and recorded with their respective revenues in the period that they were incurred instead of when they are paid. This principle works with the revenue recognition principle, ensuring that all revenue and expenses are recorded on the accrual basis. Next is accounting period. It simply states that companies should be able to record their financial activities during a certain period of time. The standard time periods usually include a full year or a quarter year. So now we have the conservatism principle. It means that accountants should always err on the most conservative side possible in any situation. This prevents accountants from overestimating future revenues and underestimated future expenses that could mislead financial statements users. Now we have the consistency principle. It means that all accounting principles and assumptions should be applied consistently from one period to the next. This ensures that financial statements are comparable between periods and throughout the company's history. Next is we have the materiality principle. Anything that would change the financial statements users' mind or decisions about the company should be recorded or noted in the financial statements. If a business event occurred that is so insignificant that an investor or creditor couldn't care about it, the event need to be recorded. Now we have the objectivity principle. In this concept, financial statements of an organization must be presented with supporting solid evidence, and the intent behind this principle is to keep the management and the Department of Accounting from making financial statements that are affected by their opinions and biases. Next is we have the revenue recognition principle. It requires companies to record revenue when it is earned instead of when it is collected. This accrual basis of accounting gives a more accurate picture of financial events during the period. Next is we have the cost principle. This is an accounting principle wherein accounts should be recorded initially at cost as well as assets at the respective cash amounts at the time the asset was purchased. Next is accrual accounting, a financial accounting method in which revenues and expenses are recorded when a transaction occurs rather than when money is exchanged. Next is we have the disclosure principle. It requires that any knowledge that would materially affect a financial statement user's decision about the company must be disclosed in the footnotes of the financial statements. This prevents companies from hiding material facts about accounting practices or known contingency in the future. So that's all. Thank you for listening to my video presentation about accounting concepts and principles as well as the definition and nature of accounting. I hope that you learned something from this video, and once again, I am Kyler Ayun M. Caballero. Thank you and have a nice day.